Elizabeth Warren versus private equity in 401k. What you need to know. The debate surrounding whether private equity should be integrated into 401k plans is growing in intensity, and it raises important questions for employees and employers alike. While standard 401k plans typically offer investments in publicly traded stocks and bonds, private companies, which have historically been accessible only to institutional and high-net-worth investors, are gaining prominence in the investment landscape. This begs a crucial question. Should employees have the option to invest in private equity through their workplace retirement accounts, especially considering that these investment vehicles often come with higher costs and less transparency compared to their publicly traded counterparts? This topic has garnered significant attention as the private investment sector and various advocates are pushing to make these investment opportunities more widely accessible. Recently, reports emerged that former President Donald Trump might take steps to facilitate this accessibility through an executive order. According to the Wall Street Journal, such an order could instruct the Department of Labor and the Securities and Exchange Commission to clarify how private investments might be included in 401k plans. Although no regulations currently prohibit plan administrators from including these assets, they have largely refrained from doing so due to concerns that it may conflict with their fiduciary responsibility to offer safe and affordable investment options. Senator Elizabeth Warren, who currently serves as the leading Democrat on the Senate Banking Committee, has been one of the most vocal opponents of this potential move to include private equity in retirement plans. Recently, she directed a letter filled with inquiries to Empower, a prominent record keeper for workplace retirement plans, challenging its announcement to allow plan sponsors the option of offering private equity investments to employees. In response, Empower, which supports nearly 90,000 corporate, governmental, and nonprofit employers, defended its decision by drawing parallels to the origins of 401k plans. CEO Ed Murphy noted that the introduction of 401k's decades ago significantly democratized access to public market investments, enabling countless individuals to participate in the investment world. He further emphasized that as the number of publicly traded companies decreases, the allure of private companies becomes greater, with the global private equity market now estimated at an impressive $13 trillion. Murphy argued that this shift presents fewer opportunities for average investors, particularly those aiming to invest in innovative or rapidly expanding companies. Murphy reassured that any new investment options will come with specific safeguards in place. He articulated that the intention is not to encourage unchecked access to complex assets, but instead to provide a controlled means of investment. He stated, "Private markets investing is not for everyone, and Empower is not suggesting that it is. Instead, the approach will feature measures designed to ensure participant safety." Notably, he asserted that investment managers would be selected by sponsors with adherence to the high standards set forth by ERISA, which governs employer-sponsored retirement plans. Specifically, Empower clarified in an email to CNN that access to private equity investments will be limited to participants with managed accounts. These accounts are overseen by professionals who align investment strategies with individual financial goals, risk tolerances, and time horizons. Moreover, any private investments would comprise just one portion of a broader collective investment trust that also includes public securities, thus diversifying risk. The company emphasized that leveraging professionally managed solutions represents the best method for incorporating private assets, as this adds an essential layer of analysis and fiduciary protection for investors. In her reply to Murphy's communication, Warren expressed some alignment with his intentions to help individuals, regardless of their financial standing, achieve long-term financial security through well-structured and responsibly managed investment opportunities. However, she criticized Empower's response for lacking substantial information on how it plans to mitigate the inherent risks associated with private markets. She particularly questioned how allowing retirees to invest their lifetime savings into risky and costly private markets would provide benefits, aside from serving the interests of private fund managers. Warren also pointed out the absence of clarity regarding Empower's partnerships with private firms, including their fee structures and incentive mechanisms. She concluded her correspondence by demanding detailed answers to her inquiries by Friday, July 25, 2025. As this dialogue continues, the Securities and Exchange Commission's Office of the Investor Advocate has indicated that it will examine the implications of including alternative investments, such as private equity and private credit, in retirement savings plans during the 2026 fiscal year. This ongoing discussion presents an excellent opportunity for readers to reflect. What do you think about the inclusion of private equity in 401k plans? Is it a step toward inclusivity and accessibility, or does it pose unnecessary risks for the average investor? Your thoughts could spark interesting conversations.